Hi everyone, this is Paul Lang from DTS, and I want to introduce you to what you're about to watch. It's an hour-long event that was presented live to free members at Disciplined Trading Strategies. This is called Scalping as a Time Frame, not a Strategy. However, I want to emphasize it isn't really just about scalping. This applies to day trading, long-term trading, swing trading, whatever you're doing. It just kind of gets magnified for scalping, so I picked this title. This is one of the most heavily commented on events I've done in the last 18 months after the fact, so be sure to watch this one. I think it's a very important one for your success. If you enjoyed this video, check out the many other educational events, articles, and Trade of the Week videos you can get access to on the DTS Free Stuff page. If you go to the home page, just look to the left and you can click on Free Stuff. Sit back and enjoy this event. Good morning, good afternoon, good evening, wherever you are. Hi everybody, sound check. How's the sound doing this fine afternoon? It is July 10th. I'm actually kind of excited to do this one tonight. I'm not sure why. I think it's because for me it's a fun one to teach because I can kind of, just really teach all out. It's kind of a soft topic as it turns out to be. I think it is, again, one of these hugely important topics. So I have a couple of introductory comments, I think, as we get going here today. I sent a special email out early this morning just kind of trying to explain. It's kind of a broad topic. I put scalping as a time frame, not a strategy. It's one of those thoughts I always have in my head I want to convey. And it kind of applies to what I'm going to teach here tonight, even though what I'm teaching here tonight applies to really every time frame in a sense. It can be deadly on a scalping time frame because you are just trading so quickly and things happen quicker. But the concept applies, and it's one of those, to me, it's probably the top career killer. As I get into this, you'll see there's maybe a couple little overlapping topics, things I've talked about before, but I think this does a great job going through this. And you may find yourself how you've maybe been trapped in this in the past or still are, or maybe you're about to experience that in the near future. The reason trading is tough, I think, for a lot of people, and I always like to say new people, but the truth of it is if you're not making money, you're new. So there's a lot of people who've been at it for 10 years that are still new. But the reason I think it's tough is because of the very fact that I have to do presentations like this. I think the presentations I do are the greatest thing I can do to help you develop as a trader. I've always made it clear I'm not teaching the technical analysis that I teach in my seminar program. Obviously, we're not doing that. But what I'm doing here is trying to give you all of the before, during, and after necessary information, which includes for the seminar students. I expect them to be and attend all of these because I find that a lot of times the difference between making and not making it is because something just clicks with you one day, and I'm sure some of you can relate to that you have all this experience, you have all this stuff in your head, and all of a sudden one day it just clicks with you. And sometimes it's just a matter of awareness. As a last minute thought I had that I just jotted down a note to myself to say that I think is very appropriate is I remember way back in my very beginning, first 6 months, whatever it was, and I was really getting organized, and I had a weird first year because I actually did pretty good the first year, but I went through the frustrations and this and that, and remember back when my quick history, I had no, for those of you that are newer, I had absolutely no market experience at all. It was 1999. I had sold a business and got some money from it, but it wasn't like retirement money. It was just kind of, okay, what do I do now? And I took a while figuring out what to do, and I ended up getting involved in trading, not really relevant why, but I started off on my own because I'm a smart guy and I can figure it out, yada, yada. And 4 or 5 months into it, I reached this day where I just, make a long story short, I don't have a lot of time today, where I just decided, hey, I don't know what I'm doing. And I signed up to get some education. Now back then, I'm not knocking it, it was the best at the time, but the education I got then, I would say is not 1/10 of what I teach today. So it wasn't like you took that and then you just went out and made money. It's not like that today. So I had to, do a lot of, in my mind, a lot of continued education experience. And there came a day where I said, you know what, I'm going to just kind of synthesize everything I know. And I wrote down all of this stuff. And I made kind of, just kind of try to synthesize all these notes and junks, and at the time, even books and magazines, and said, I just need to boil this down to what it is I want to do. I guess you would call that a trading plan today, even though it was kind of more for me just synthesizing notes. And when I got done and I put it all down on a piece of paper, I read it. You know what I discovered? Anybody done that maybe? Anybody have a clue? I'm going to have a sip of beverage here. What did I discover after going through this thing of just doing a great job synthesizing everything I had learned? I'm kind of talking about what I had learned over 6 or 7 months. Took some classes, okay, great. it got me going in the right direction, but was kind of frustrated because it wasn't always going right. And I went through and just cleaned everything up. No, well, that's what I tried to do now was get rid of the extra stuff. I boiled it all down. I'm good at boiling it down. I boiled it all down, and here it is. Here's the final synopsis of what it is I want to do. No, what it turned out to be was everything that I already knew. I mean, there's really nothing of a revelation that was new. It's stuff I was already doing and stuff that I knew and stuff that I'd written down in the past. It's just awareness. In other words, I wasn't really doing it. In other words, I knew what to do because when I went through and said, okay, put down everything that's right about what you're supposed to do, and I put it all down, I said, you know what, this is like what I wrote 4 months ago. I'm just not doing it, right? So does that ring true with any of you? I mean, I've heard somebody say a similar thing where they went to write an email to me about how they developed, and then they were embarrassed to send it because it was just kind of everything they were taught. It was kind of somebody said I was going to write you an email about all the additional things I learned on my own, and when they wrote it down, they realized it was everything they'd already been taught. So awareness is the thing, and that's what I think a lot of tonight is probably about. And I have another comment for all of you. And it's a frustrating one to me. People are stubborn about learning. Maybe I'm in that camp too, I don't know. But people are stubborn about learning. A lot of you are very stubborn about learning. You're just closed mind, don't want to accept new information, and you're stuck in a rut. And that's great if you're doing great, but if you're not doing great, you got to wake up and change and look around and say, hey, you know what? 90% of the people who tried this fail, and I'm doing what 90% do. When am I going to change? If that applies to you. There's the opening slide. The best way to make this point about tonight, scalping is a time frame, not a strategy, which really applies to way more scalping. The best way to make this point is to take you through a journey that you went through as a successful trader, or the journey you are currently battling if you're a developing trader, or the journey you failed if you had to quit already once. So I'm going to take you through a journey so we can go through this step by step of exactly how you develop a terrible mindset. Let me repeat everything I just said because it's key to what I'm doing tonight. I'm going to take you on the journey that you have all been through, I guarantee you. As a matter of fact, as I go through, I want to see some light bulbs, some little LBs, because you're going to say, yeah, Paul, I've been there, done that. So I'm going to take you through this journey, what we've all gone through. Some of you will chuckle because you're a successful trader and you say, yeah, I went through that. Some of you are going to look and say, yeah, that's what I'm doing now. What's wrong? I'm stuck. And some of you are going to say, yeah, now I kind of know. I already blew out an account or lost or had to quit for many years, whatever it is. So let's talk about it. This involves actually, for the most part, I talk about a three-legged stool. There's a separate presentation. I think it's one of the Hall of Fame ones, so you can see it on the free stuff page, about the three-legged stool, which is superior technical understanding. It's not really what tonight is about. Psychology and or experience, that's always involved in everything a little bit. Math and probabilities. This really gets into the math and probabilities thing a lot. It's incredibly important. It's one of the three legs. Most people don't even know what that means. So, what makes a good trade? What makes a good trade? Simplest question in the world, right? There's a lot of answers to this, obviously. But I'm just talking basics in terms of my point tonight, which is all kind of about share sizing management, money management, chart management. It's a combination of two things. I'm not going to quiz you on it, just it simply is. It's the move to your target compared to the amount you allowed for your stop. Now here I'm drawing some boxes. In other words, this is kind of your entry. This is what you're allowing for a stop. This is where you think your target is, okay? Just a theoretical chart up here. Doesn't matter what it is, where it is. We're just talking theory here tonight. So obviously this is what you know beforehand. It's called reward to risk, right? And afterhand, anybody know the name for it? We call it after the fact, after the trade, and you calculate this number on average. What's that number called? Beforehand, it's called reward to risk, yeah. I always said risk to reward, the way we phrase the number. Yeah, the after the fact reward to risk is your Sharpe ratio. Yeah, I'll get to a slide on that. So number one, and this is all, just basic. Obviously, a good trade means, one way you could have a good trade is that the target you get to is somewhat bigger, significantly bigger than the stop that you have. Vito, I don't know, you ever did scalping? You're 100% long term. Well, Vito, I guess you don't know me. Number one, and maybe you must have tuned in late. You kind of tipped your hand. You tuned in late because I discussed this already. This isn't really about scalping. And no, I'm not just a long-term trader. I'm a day trader. I run a trading room during the day. I'm a day trader. I don't like scalping per se myself if you saw me enter trades, you think I was scalping, but I like to kind of be a long-term day trader, like holding half day, and I do long-term trading. But even though I explained this title scalping is a time frame, not a strategy, it really applies to everything. You'll see why if you just bear with me here for a minute. So what makes a good trade? Combination of two things. Number one, having a bigger move to the target than the stop, right? But that could vary somewhat. It could vary depending upon what? It could vary depending on number two, right? How often you get to that target compared to how often you get to that stop. And what do we call that? That's just called your batting average. And I put duh there because there's nothing shocking about that. I just want to start at a basis point here of where it is. The combination of these two is what's called expectancy. It's not really critical, you know that or get it. But what that means very simply is that it just gets a double duh, is that the smaller your target, the more likely you will hit it. Is everyone with me? Does everyone agree with that? That you can have a smaller target and hit it more often, or you can choose a loftier target and not get there as often, right? That's the balancing act. Does that make sense? So with that balancing act between taking a target quickly or getting a bigger target, which is really the distinction between the balancing between your reward to risk or your batting average or your Sharpe ratio and your batting average, you can always increase one at the expense of the other. Anybody can do that. Matter of fact, to make that point extremely clear, let me ask you a question. Let me ask who would like to take this bet with me. I will bet you that for the rest of the week in the trading room, I'll take at least 12 trades and I will bat over 90%. I never do that. Do anybody want to take the other side of that trade? Yes? You'd bet that I cannot do that. I'm going to tell you that I could bet 95%. I'll take 20 trades and I'll bet 95% or better. Do you think, I don't want to ask two different questions. Would anybody take the other side of that bet? I normally bet 50%. I'm just trying to make a point here. Exactly, Jim. That's my point. Is that if it was all about batting average, right? I could just simply take. Okay, fine. Here we go. I'm going for a 2-cent target. I have a $2 stop. Do you think I get 19 out of 20 trades right? You bet I could, right? Very simple. And I could reverse it too. I could say, hey, I'm going to have a 5-to-1 reward to risk ratio the rest of the month. If you bet me $10,000, I'd go do that because all I'd have to do is simply say, okay, $1 target, 20-cent stop. And it doesn't matter if I get 99 losing trades in a row. If I make one winning trade, I may lose a ton of money, but my final Sharpe ratio will be 5-to-1. Final reward to risk will be 5-to-1. So I just want to make that point that it's very easy to trade off between the two because that is what most traders do. They simply trade off between the two. Next, which leads to the question, here we go, we're starting to get more. So this is basic, I just want to make sure we're all on the same page here. What do most traders prefer to do? Hit lots of small targets or hit less big targets? That's a real question for you guys. Small or big? Small targets or big? Do most traders want to hit lots of small targets, put small or S? Or do most traders want to hit less big targets, put B? And the answer to this question is not even close. It's in the 90% range. That's part of what tonight is about, Jim. You ought to like this, right? Most people end up with small targets. Now, I didn't say that was the plan. Small targets can be the plan. And by the way, I'm not against small targets, keep in mind. Small targets might be the plan, but small targets, usually there's a big target plan and the small target is taken. Psychologically, we are all wired to not want to be a loser. We're all wired to want to be a winner. And that means we feel good if we're taking targets. And unfortunately, that dumb part of the brain we're relying on, which has to do with not being a loser, is not the logical part of the brain that's saying, hey, the goal is to make money, not feel good about yourself, right? Top of the slide. Now, you may be thinking you've heard me discuss this, and you have. But here's where tonight really starts. And by the way, it's not important, but the fancy terms to use are batting average and Sharpe ratio. Sharpe ratio is the after-fact reward risk. So your batting average percentage winning trade, Sharpe ratio, the average winner compared to the average loser. And as I mentioned a minute ago, it's very easy. They're inversely related. So it's very easy to just say, hey, I'm going to take more cheap targets. Your batting average goes up and your Sharpe ratio goes down, or the other way around. But if you just, like a teeter-totter, if one goes up while the other one goes down, you never make more money. So to improve, you have to obviously hold one of those constant and get the other one better, higher, more money. So here's where I want to walk you through. Here's where tonight starts. You have a target in mind. It may be the right target, it may be the wrong target. Targets are hard, are not easy things to pick. It really doesn't matter for this discussion whether you've picked the right target. Now, it may matter in some other sense in terms of if you're picking goofy targets you can never get to. But that's a whole, it really doesn't matter. The point is, whatever it is, right or wrong, you have some plan, you have some trade, whatever it is. And even if you don't, even if you're so unorganized or unplanned that you don't even have a real target, there's something you're going for, right? There's something that's going to make you say sell. So you have some kind of target up here that you're thinking of. Here's your entry. Here's your stop, right? And you're going to go for this target. But you don't get there. It comes up a little short, and then you stop out. You were up money, and now you took a loss. And maybe you were taught, or you just feel that a good trader should not let a profit go to a loss. You may have been taught that, by the way. Now, but don't make a comment on the screen because you'll make me unwilling to read this next line because it's right in the slider. Anyone who says you should never let a profit go to a loss is a fool. You're just an idiot if you say that without more clarification. Because taken to the extreme, it means that if you're up 1 penny, you have to stop yourself out if you go 2 cents lower than that, right? So that's silly. Naturally, we want to have a defined management plan and we want to define what exactly it is that we want to start protecting and when it is we want to start selling and all those good things. But the simple concept in your mind, which so many traders have, by the way, that you can't let a profit go to a loss is idiot speak. I'm sorry if that offends you, but you need to hear that. And the reason that it gets easily absorbed by people is because it goes along with your trader psyche, right? Your psyche says, hey, I don't want to be a loser. I'm up money. Can't go broke taking a profit type mentality, right? Does this make sense to everyone so far? Do you have any comments along the way so far? We're just getting started here really with my main point. But I think you're all aware of this fact so far. We're going to keep building this, right? So you have a target, you come up short of the target and it stops out, and you don't like that, right? You don't like the fact. Now, it could be maybe there was some mistake made. Maybe you had enough money, you should have protected some. But the point is, how do you handle it when you come up short of a target? Well, what most people end up doing is that they say, you decide next time, because you don't want that to happen, you're starting to form some kind of management plan here, and it's not really a properly formed one, it's being formed by default because you're mad, because you're losing money. So you decide that if you get close to the target, and it looks like you're not going to make it, you will lock in profits. Has anybody ever, be honest, currently now or in the past, has this vague notion ever become part of your trading philosophy? I mean, in a sense, it should be. I mean, a part of everyone's plan has to be how do you handle this situation, right? But unfortunately, this is what most people define it as, just like this, what you see on the screen here. Well, if I get close and it looks like I'm going to start falling, I'm going to get out, right? And when you say those words, and this is, by the way, this is exactly what most people would call their plan. In other words, most people don't have a formal plan. They don't have a written plan. They really don't know how to manage. Remember, if you're managing a trade, let's say you're day trading and you plan to hold a trade for a couple of hours, and you're going to manage that. During that 2 hours, let's say, here's a real good question for you. Let's say you just take one trade, that's all you're going to do. You're not looking for another trade. You got in a trade, you're happy with it, and you expect to hit your target in about 2 hours, and you're managing on a 5-minute chart, let's say. And some of you may not even know what all this means, but that's okay. Over the next 2 hours, how much screen time should you put in to watch and manage that trade if you're a good trader? If you want to be very careful and cautious, well, you have to put some in, Carl. I mean, you can't put on automatic. Yeah, well, yeah, you got the idea, though. I mean, you should be no more than 5 minutes or whatever, right? I mean, but yet, what do most people do, Steve? They sit there and stare at it, right? They're just staring at the trade. And you're like, well, why? Yeah, I mean, you put your initial stop in. But my point is, like on a 5-minute chart, whatever management policy you have, it probably involves something that can't happen in seconds, right? So maybe after 30 minutes, your chart looks like this and you decide to raise the stop. Well, okay, well, that took at least 20 minutes to develop. So maybe you peek in, in a half hour or whatever. Here's a good story for you, and this is just so exemplifies what happened. And this is a long time ago, but I'll never forget the story. I had a trade in the trading room, and it was one of those, the kind of the best trade of the week things. Stock had a great run, no problem managing it, just kind of had a nice little pattern, went higher, maybe sold it at the end of lunch or something like that, made 3 or 4 hours. It was just, really, really nice trade, made the week. And, when I closed it out, some high fives in the room, whatever. And then somebody said, oh, yeah, I barely made any money on that. Well, what happened? Well, I decided to exit when the market tanked. That's what they said. Now, the market did this. It was long. The market did this the whole time. That's all the market did. We were trading a stock. We weren't trading a market, right? And right away when this trade started, they called that the market tanking right there. In other words, a red 1-minute bar showed up and they felt the market was tanking. Who's making that decision to get out because the market's tanking? Who made that decision for that person? Those of you that know how I talk. Right, that person's an idiot, right? Which we all have. And that's who's making this decision, is the point I'm getting to here, right? When that's your wording on something, you're not in control. There's no chance you're in control. Right? When you get close to a target and it looks like you're not going to make it, well, here's what happens, and here's the slippery. This is how it begins, right? But you come up short, and here's the slippery slope that starts, right? Now targets become only theoretical because every time you get close to the close you're almost close to, now it's another time where you're going to get out if you need to. You know what I'm saying? Right here, this slide. Just give me an LB or a yes. Are you all familiar with this slide? Where the targets just keep shrinking and shrinking and shrinking because you never ever want to give up anything. Yes? You've been there? Everyone should say yes because in a sense, nobody wants to give back anything, right? But you can't do both. You can't hit a reasonable target and lock in every penny of profit along the way. It can't be done. It's not possible. It could be, but it would involve something I've never seen happen in my career. And that would be for a stock as a day trade to go up a penny every minute for the entire day and never pull back 1 penny, right? Then you could do it. A swing trade would have to go up a dime every hour for 4 days and never pull back 1 time. That never ever has happened in history. So if that's not what's going to happen, is you have to deal with rallies and pullbacks and decide how to handle it. And if every time you pull back as a swing trade, if you pull back 30 cents, as a long-term trade, you pull back $2, as a scalp, you pull back 5 cents. If that's going to knock you out all the time, well, you have to decide if that's your plan and how to handle it, and then the batting average you need to maintain that. So again, I'm just taking on this road of how we all think. So you start off saying, here's my target, I'm going for my target. Then you get to this thing where, okay, I'm not hitting my target, so I'll let myself cheat a little bit. And cheating gets more and more and more cheating until you just say, well, it's close enough. And now we're not even really going for targets anymore, right? Now we're in this gray area where we're just kind of saying, well, if it goes in my direction, I'll make sure to make some money, right? So what happens when you're trading like this, everyone? I'm going to give you a little time to think about this and answer. When this is what you've come down to as a trader, which is, you're kind of in the gutter at this point. I hate to say it, but you kind of are. But when this is what you come down to, where you're just kind of like, all right, I can't get to a target, I'm not real sure how to manage, and I'm just going to take anything so I don't lose money. What ends up happening? Where is your P&L at this point? Assuming you're pretty good. You'd have to assume you're pretty good. Yeah, what I put on the slide here is right. You go into instant management mode, right? You go to instant management mode. Steve, yeah, exactly, right? You end up with just a bunch of these little gains, but you're saying, okay, well, at least I'm winning. But the problem is you're still going to have a loss, right? You're not every trade is going to go immediately to some small target, even if it's a small target, right? Some of these are just going to, go the wrong way when you get in. And what happens? Those become stop outs. Well, unfortunately, the stop outs usually aren't as small as the winners are taking. So you have a stop out that eliminates multiple winners. What's the answer to this for most traders? I don't even want you to guess because it's embarrassing. Here's the answer most people come up with, right? You're feeling kind of good about your trading, which is just a falsehood because you're taking a lot of targets, but you're not making money. And what you're saying to yourself at this point, and some of you are going to say, wow, it's like Paul is reading my head or something. Well, it's because I've been there, I've helped people in there. And what you're saying at this point is, well, you know what? I'm getting a lot of winners, and I'll just do better holding next week, next month. Do you ever do better the next week or next month? The answer is, for most people, 90% of the time, no, they don't, because nothing really changes. So here's the answer most people come up with. You're taking a lot of targets now, you have a problem. You still have stop outs, you always have stop loss, you get wiped out. So you come up with this genius plan that no other trader has ever thought of. Just increase your share size dramatically so those small winners you get comfortable taking will make more money. Who's been here? Who's been here? You follow the progression that I'm on though, right? You follow the progression I'm on, right? Can't get to a target. Now we're small targets, bigger losers. You're breaking even. You feel good, and you look at your things and you say, hey, you know what? These little targets I'm taking, if instead of taking 1,000 shares, if I would take 4,000 shares, I'd be killing it, right? Notice the wording on top, very important. This is how this is how the problem I'm talking about starts to accelerate. Here's the problem, is that does nothing to increase the odds. Now, not all of you are admitting or typing what you've done, but all of you have been here. All of you have been here. Some of you got past this, and you're doing okay. Some of you are struggling with it right now. And as I said in the beginning, some of you, this made you fail. I don't want to hear which category you're in, I don't care. But do you all agree that increasing share size does absolutely nothing to increase your odds? You agree with that, everybody? 100%? I don't know how you could argue with that. Do you agree with that? Right? All you're doing is magnifying whatever you're currently doing, sort of, right? Unfortunately, you cannot raise your share size on your winners only. That's what people are thinking mistakenly. And you know, when people start trading, it's weird because smart people turn stupid sometimes. And I hate to say it, but it's just true. Because I talk to people that I just know are really, really smart, and I'm listening to them talk about their trading. I'm like, you're talking like a 5-year-old. You're just going to increase the share size on your winners? Hey, that's a good one. I wish that you know, I knew my winners ahead of time, and yeah, I would share size them like crazy. Unfortunately, you cannot raise the share size on all your winners. So your winners are bigger, but your losers are proportionally bigger. So nothing has changed other than the magnitude of the move. So here you are before, a little winner, a little winner, a little winner, normal loser. I'm not even saying it's a big loser, right? In this scenario here, you're not taking big losses. I want you to understand that's just a normal loss. If you're risking $500, that's a $500 loser. But you're taking all $100, $100, $150, $150, bam, give it all back. So now you decide to triple your share size. Great, fantastic. All right, so now we got 300, 300, 300, 300 minus 1,200. And at that point, you probably are, you know, going beyond what you wanted to lose on any certain trade. Here's is where, and it says up on top here, now you are toast. Because here's the problem. It says here that you're just proportionally increasing your winners and losers and it all comes out the same. That's not really true. That's not really true. Why is that not true? Now, again, the question here is getting kind of in-depth, right? So I'm saying you have, you've come down to the gutter here where your plan is you're taking small targets and then a loser wipes them all out. And then you decide, okay, I'll just increase my share size so my winners are 3 times bigger, but then of course your losers 3 times bigger. And then the first slide said, well, all you did was increase both proportionally, so you're still at 0. Actually, you're not at 0. You're going to be losing money hand over fist. Why? Mathematically, you should be at 0, right? If I triple my winners and triple my losers, and I was breaking even, I'm still breaking even. That will not be the case. Why? And this is an important part of tonight. Why? There's 2 reasons. If you don't know these reasons, you're going to forever struggle. Begin adding to better price. Okay, that is one of the bullet points I have on one of the slides coming up. Yes, I know what you're saying. Glenn is saying that on the losing trades, that you may actually make the decision to start adding to average down, right, Glenn, on a long trade to try and fix the trade, and that could result in a huge loss, and that's absolutely true. That is something what people start resorting to sometimes. Well, the reason is when you all of a sudden, let's just say triple your share size to try and make more money. Number one, are you going to actually triple your winners? The answer is not a chance. Not a chance, right? If let's say you were going for $500 winners before, let's say your risk amount was $500, right? And you're just making $100 winners, so you decide to just up the share size like crazy. Well, if you're tripling your share size, it now means that your normal winner, if you got to the target on the chart, should be $1,500. But when you start getting into the bigger amounts of money that are that much greater than your risk amount, what do you tend to do, everybody? What do you tend to do when the money is adding up really fast, even though you're not getting your target on the chart yet? You still have room to go. Right. You're right back. Right. We go right back to the problem I showed you on the first slide, is that now we're back to this thing where, okay, now I am going to take a smaller target than what the chart said because the money's adding up really quick, right? So you're thinking, okay, I was only making $150 a trade, and now I just made 400, right? I'm thrilled. But the problem is you had to make 1,200 or whatever because you tripled your risk, and the losers are going to be bigger. So one side of your brain is saying, take it, you're up more money than you've been up in a while. But then the logic of it is, wait a minute, we have to get triple the winner we had before. So the original problem you had about not getting to a target becomes triply strong. Is that clear, everybody, or you want me to repeat that? Does that make sense? So the thing I'm discussing here is why, if you were to triple your share size, then not only is it a non-event because you didn't increase your odds and you're just tripling your winners and tripling your losers, it actually is much worse than that because, number one, you will never get to triple winners. You'll never get there. If you're having this problem, and that's why you're doing this, you're never going to get to a triple the normal winner you would have money-wise. So there's number one. It's just human nature. And it's why not everyone is cut out for trading. So you're going to be cheating targets more than you ever cheated before. And number two, your losers are not going to be just X time. Yeah, I put X on here, so I'm saying 3 now, right? Your winners, if you tripled your share size, your winners, I'm pointing at the screen like you can see me, your winners will not be 3 times bigger. And your losers will likely be more than 3 times bigger, X times, whatever times you've increased your share size. Why? Well, because the losers are bigger, the losses are now bigger, and you more likely will be a deer in the headlight. We all know what that means, right? It just you just kind of freeze, right? If you're normally we're saying, okay, I'm just going to take a $300 my maximum loss. Well, you tripled your share size in order to get more money on the winners, but now all of a sudden this trade just starts off right in the gutter, and boom, you're just $300, $400, $500, $600, $700 down. And you're already double what you're normally taking as a loss. And what do? You tend to be a deer in the headlights. And then you come up with all these great comments. Well, this loss is too big to take now, right? It's not a loss until I actually exit the trade. And certainly if I come back, I'll feel like an idiot if I exit because certainly if I exit the trade, I'll feel like an idiot because it's going to come back, right? And then here's Glenn's comment is, hey, it dropped so quick. What if I just buy some more shares down here and average down to save the trade, right? Does everybody see these comments here? Because I have a real important comment coming up next. All these comments here. If you ever say one of those to yourself or think any one of these are valid, you're done. That's it. Put a fork in you, you're done. And that's how you end your career. And whether that's because you just eventually bleed out of your account or you just keep losing money until you say, I got to quit, this is how you lose. And that's why this topic is so important to me. I've walked you through exactly how it happens step by step. And this is what happens to everyone. None of you can say this didn't happen to you. Again, some of you understood how to get beyond this. I'll talk about how to fix it in a minute, the best I can. Some of you understood how to get beyond this. You're successful. Some of you right now are banging your head on the desk every day because you're going through this right now and you don't know what to do. I talk about, and again, so much stuff starts to overlap, but in many presentations, I talk about the break-even blues. And that's, I address that, halfway through this process. That's what you get in for a long time, where you just keep taking so targets, and you're trying to, get more, but you never do better, and you're just breaking even for a while. And then when people get really frustrated, and you stay in break-even blues for quite a while, most people do, where you're just sticking to your share size, but you just keep thinking, I'm gonna do better getting to targets, but you never take any proactive steps to make you better at getting to targets. So you get in that break-even blue stage for a long time until you finally just get frustrated and you say, I can't keep doing this. I got to change something, and then you pump up the share size, and then you bump up the share size, and then you accelerate the problem, and you have to end up quitting. Once you start thinking like this, you just can't react to the loss. The loss is too big to take. It's not a loss till you exit. Certainly it'll come back, or you start averaging down. You're now down a wormhole from which you will never recover, period. Your career is over as a trader, whether it's this week, next month, 6 months, whatever it is. And again, I want to emphasize, and maybe you can see now why I have a hard time with this title, this applies to all time frames, right? You could be doing this as a long-term investor, where you want to hold something for a $7 target over 6 months, and you take $1 the first week, right? Because you just can't see that, you don't want to see that money disappear. It can happen to you as a swing trader, as a day trader, as a scalper. And the reason I kind of titled it scalping was simply because as a scalper, you can just kind of burn out your account in a very short period of time. See, as a longer term trader, if you're just making a little bit of money, maybe you're okay, because maybe this isn't your income. You're just saying, hey, I'm doing another job, I'm doing whatever, and if I make a little money, I'm fine. So you're taking these small profits. You're never going to be a good trader, but you're making a little bit of money maybe, so it's not a big deal to you. But when you're all of a sudden now saying, hey, I'm going to make my main income from trading as a day trader, or as a subdivision of day trading as a scalper, all of a sudden now all of these problems accentuate because you have to make money, right? And that's why it becomes such an immediate crisis issue for a lot of people. So what's the answer to fixing this? Well, the answer is scalping is not a strategy, it's a time frame. And again, I'm going to use the word scalping here, but I want you to think about scalping applying to kind of just taking quick targets, whether you're a long-term trader or whatever it is. When people say I'm scalping, well, when you are truly scalping, that's not a strategy. People refer to it like as a strategy all the time. Or they'll say, I'll just scalp it out, whatever that means. It's not a strategy. All that means is that here's a chart, right? I went long here. Nice entry. Got a nice target. I'm thrilled, okay? If this is a weekly chart, I'm a longer term trader. If this is a daily chart, I'm a swing trader. If this is an hourly chart or a 15-minute chart, I'm a bigger part of the day trader. If this is a 5-minute chart or a 2-minute or a 15-minute chart, I'm a little quicker day trader. And if this is a 1-minute chart or a tick chart, I'm a scalper. So you see, nothing changes. Does everybody understand what I'm saying here? Scalping is a time frame. It just means that your charts of focus are 1 minute or scalp chart or tick charts. So nothing changes, and you can't you can't justify anything you're doing, as I've discussed all throughout tonight, by saying it's a strategy to do this. It's not. It's just bad math, and it doesn't work. Your chart and money management, and here's a line I came up with for this that I've never said before, but it's great. Your chart and money management can magnify your trading ability. It cannot replace it. That's the one that should hit home now at this point, because we went on this whole journey from starting off as a trader and trying to get to targets and went through the process and how we get screwed up. And here's the bottom line. Does that make sense? Your chart and money management can magnify your trading ability. It can't replace it. You can't squeeze blood out of a turnip. You can't take a non-trader that doesn't know the chart and say, well, if I just manage this right, or if I just do whatever with share size, I'll make money. If you're not making money, there's nothing in the world you can do mathematically to change that. I'm sorry, it wasn't 100% correct the way I said it. If you don't know the charts and you're not picking trades that have a possibility, then all the management world doesn't help you. Now, it is possible sometimes. I know, as a matter of fact, the majority of losing traders actually know the charts well enough to make money, and their management is so bad that they lose money. That's a little bit of a different story. So what is the answer to fix this? Within a scalp of 20 to 40 ticks, there are support and resistance areas, a smaller. Yeah, exactly. Right. Exactly, Mike. Absolutely 100%. And that's my whole point. And matter of fact, I was going to put in here, but I just knew I was going to run way over. I was going to put in here a chart and pretend it was a weekly chart and run through everything you could do on it and then say, oh, by the way, this is a 1 minute chart or a tick chart. What's the difference, right? As a matter of fact, in some sense, Mike, you in a sense, and I'm not sure this matters in the bottom line, but you kind of have more information the smaller you go down in time frames because there's more time frames above you. In other words, when you get up to a weekly chart, I always talk about looking 2 time frames above. You really can't do that because the only thing above you is the monthly chart. We don't really look at yearly charts. So when you get to some level, there's less above you because you're at the biggest level already. When you're down on a 1 minute chart or a tick chart, wherever you're on, every chart is above you. Right now, naturally, I don't want to get into what charts you should be looking at, but obviously there's a limit. We're not looking at a monthly chart as a tick trader. There's a limit, but theoretically, you have all this other information above you, which is all helpful to you, right? Well, yeah, obviously, Mike, right? Yeah, I mean, if you have a weekly buy setup, let's just say you're waiting for let's say you're waiting for the chart to drop another bar into some area, just making up a strategy. Well, as a weekly trader, you have a whole week to watch it, right? As a swing trader, you have a whole day to watch it. As a longer term day trader, you have 30, 60, 15 minutes to watch that bar develop, right? As a 5 minute scalper, you have 5 minutes to watch the bar. As a tick trader, you got to be sitting there because it can happen in seconds, right? It is, I believe, harder because the emotion is magnified 1,000 times. And I think for unskilled, it's like, again, that analogy of kid in a candy store or kids being drawn to a construction site. Because for a lot of new traders, they get drawn to that because it's the cool kid's term scalp and you can make money real fast. But I think you need more expertise to scalp than any other time frame. And it's a bad combination. So you got people coming to do it that don't have a clue what they're doing. Right. Hey, it is easy, Mike. You just take a bunch of shares and sell them when they go up. That's a piece of cake. Anybody can do it. So what is the answer to this? And you probably know, let me see if I give you a quiz here. What is the answer to this? So we went through this whole thing, and I hope I loved how this went. I hope you appreciate and could follow it okay, because it is what you all have been or are going through. And now you come to this end, and you say, okay, well, what is the answer? You should kind of know the answer. What is the answer? What's the answer to, I guess, part of tonight could be called how to fix the break-even blues. Well, tonight goes beyond the break-even blues. It goes on to say that once you're in the break-even blues, a lot of traders try to fix it by increasing share size, which leads to a disaster. So how do you fix this problem? Yeah, well, Carmen, it's that's no offense, but that's kind of just the slimy answer, because you can always say trading plan. But the next question is, Carmen, what should be in your trading plan, right? Of course, you have to have a plan and stick to it. But my real question is, okay, what should be in that trading plan, and how do you fix this? What goes in that plan to fix this? You guys are smart. You got it. What it actually is, if you were really, really, really on top of things tonight, you would say, go back to the first 2 slides. Think about that. Here are the first 2 slides. What makes a good trade? A combination of 2 things. How much you move to get to your target compared to your stop, and how often you get to your target, right? The smaller the target, the more likely you hit it. In other words, one of the first things I introduced to you tonight was this concept that in order to increase your odds trading, all right, obviously share size just magnifies what you're doing, but to actually increase your odds, you have to get better at understanding either getting to bigger targets with the current stop you're using or getting more trades successful at whatever target you're going to. And bottom line, the only way to do that is to have a better understanding of technical analysis. And that's just what it comes down to time and time again. There's no way to cheat that. There's no way to shortcut that. Now you're going to be going on the big spiel here. There is no magic strategy. There's nothing you plug into. There's no one thing you download. It's just understanding a chart, finding what I call that moment in time, understanding that technical analysis, one of my definitions is simply the battle, understanding the battle between the bulls and bears across the 4 time frames that matter for whatever time frame you're currently trading, and understanding how to do that. And as I've mentioned, I may kind of harp on a little bit more, is that everybody's big on, the cookie cutter names for strategies that never work. If you're going to tell me you're using a head and shoulders pattern, you're a fool. There's no such thing as a head and shoulders pattern. Yeah, I know what it is. Yeah, I know you can show me trades that work. You never, ever, ever should enter. As a matter of fact, if you actually translate what a head and shoulders is, my seminar program would teach you that you are not allowed to enter that trade there because it's the lowest odds thing in the world. So I'm not big on names. As a matter of fact, I'm so anti-name that you can take trades when you know what you're doing that you maybe can't even put a name to. You just look at the chart and you say, you know what? That's higher. Not because I'm a fool, but because I know the chart and I know that's going higher. I'm going long over here. What'd you call that trade, Paul? Well, I don't know. I'll have to kind of make up the strategy that best fits it, but it's going higher, right? Do you see what I'm saying? And that's what you have to do, is just get this better understanding of charts. And I mean at that high level, not the garbage stuff that you see in here in 3 bars and over a bars high and all that. I mean, and then also management and understanding how to manage entries and understanding that different entries should be used for different setups. If you don't know what different entries means, you're not at the level that you should be risking money, really. So questions, go ahead. Can a good trade ever have a target, stop, then target? Oh, yeah, now that I understand what you're saying, you worded it perfectly. I just was on a mental block. Yeah, of course you can, Steve. Yes, absolutely. And that's more and more likely the lower you go down. No matter, a scalper is possibly could have that setup. It's just a matter of math. So you could, as a scalper, be just making some numbers. Just say you're going to risk $300 and you're taking $200 profits, right? Well, if you get 4 out of 5 trades right doing that, you're making money hand over fist. So it is just that balancing act, and there's no rule that says that you have to have a 1-hour target. As a matter of fact, those of you know that take class with me, I never ever teach a reward to risk. Maybe this would be a helpful conversation. I do not teach a reward to risk as being a necessary part of a trade. How about that one? I don't teach a reward to risk, but for a whole lot of reasons I explained in class. But when you think about it, to require that is foolish in a sense, because let me explain why for a few different reasons. Number one, I've heard traders. Are you guys talking to me? Bad plan. Well, look, okay. Well, let me explain why. Number one, I know some traders say, "Oh, you have to have a." Now, Mike, let me clarify this. I will always pick a chart where I think I found that moment in time where the potential move greatly exceeds what I'm going to risk, right? But to specifically say I have to have a target in mind, I'm going to stick to that's 3-to-1 or whatever. If you look at most traders that say I will only take a 3-to-1 trade, most of the time they end up with a Sharpe ratio of 1 anyhow. So I mean, it's a fictitious thing if you're just picking a make-believe target and then you're managing it such you never get there anyhow. So yes, I always want the right chart. But here's the other thing. Let's say I have a 0.9-to-1 target. 0.9-to-1. So I'm gonna risk $500 to make $450. But let's say I told you that chart absolutely positively, I'm 100% sure, has an 80% chance of getting there. Anybody with 5th grade math skills, would you take that trade? Yeah, hand over fist. Here's number 2. I also teach a concept where we may be starting a trade and adding shares to it. So if you saw this trade and you said, oh, that stop is just too big, well, what are you actually saying? You're saying if you love this chart, right, and you're saying, oh, that stop is too big, I guess you're saying you have to pass this entry, right, and wait for the next entry. Okay, well, there's your next entry with a nice stop, but why not take shares here and use this profit and roll it into the next trade you're going to wait for? Why just, in other words, why step over a $5 bill because you want a $10 bill? Why not pick up the $5 bill and then invest it with the $10 bill when you find the $10 bill? So there's a whole lot of reasons I go into that, but the bottom line comes down to it's simply a function of what we call expectancy. It's simply a function of how often you get to that target compared to how big that target is compared to your stop. And there's all kinds of numbers that work. The obvious break-even number, if it's not apparent to you, is if you have a one-to-one reward to risk and you're batting 50%. You make $500, you lose $500. You make $500, now increase either one of those and you're starting to make small amounts of money. If you're one-to-one, you bat 60%. Well, if you get the share size up there, you're making good money. 70%, you're killing it, right? 50% batting average is great. If you're making even 1.5 to 1, you'd be killing it, right? So it's all just a matter of the math that goes into it. I want to focus on one more thing though here, right? And that is that very last line. This is the last slide here. So you guys got the idea that, and I have nothing else to add to that. I'm just going to tell you the obvious, that people are so stubborn about wanting to do this for some reason. They'll try everything and anything. And it's been one of my biggest frustrations this year, a frustration that I can't even explain to you how bad it is. Not for me personally, I don't care. My life doesn't change, but there's people, I know the people that I go through and I train, they're happy, they do well for the vast majority, and there's people that just refuse to want to think they need to get any kind of education because there's nothing to learn. So learn to read a chart, critically important. But then the other half of that is, even if you know the chart, most people struggle not with learning the chart. You have to learn the chart, but then the management is what they end up struggling with. And a lot of times management comes down to discipline. If you ask these people, they'll often tell you that they seem to know what to do to manage, but they just can't do it. What is the best way to get discipline? And this is, I did a whole presentation about this answer. What is the best way to get discipline in terms of trading better? Keep going. Best way to get discipline. I did a whole presentation on this. A plan, do all or nothing. Have a written plan, journaling, do the same thing over and over, study, track your trades. All those are great answers, but it's not the best answer. Discipline is a measure of capacity of endurance and tolerance, okay? That's a definition. It doesn't help us really. Fire the idiot, good answer. Track, absolutely. All good stuff. Nobody mentioned a common one normally comes up as self-improvement type things, trying to, fix things even beyond trading to give yourself discipline to do stuff. All those are great, but it's not the best answer. I'm surprised nobody got this because I did an entire presentation, and I think it was called self-improvement. Nope. You do not have a lot of people tell me that they're not trading well because they lack discipline, and therefore they need self-improvement. You ready for this line? This is my line that I did in that presentation, is that you do not have the right, maybe some of you are starting to ring bells, you do not have the right to claim you need self-improvement until you prove to me you really know the charts. In other words, how can you ever manage properly or have the discipline to manage when you don't really know what you're doing? Remember I gave examples about giving a speech, right? If you're giving a speech to a large group, you're confident, no problem at all. Give a speech about something you don't know and you're fumbling. If you don't know the charts and you have no knowledge at all, no confidence if you'll ever get to this target, how can you possibly have the discipline to get there when you just don't know you're going to get there? Do you see what I'm saying, everybody? You may eventually have a discipline problem. You may become an expert chart reader and say you may know exactly what to do and you'd be right a lot of the times and you find you're not doing what you're supposed to do. Then you have a discipline problem. But for 99% of people I talk to, they don't have the right to claim a discipline problem. They have a knowledge problem. Everybody, does this make sense? It's so important. If you don't know what you're doing, you'll never be good at it. You'll never have discipline if you don't know what you're doing, right? That's the first step. You don't have the right to tell me you have a discipline issue until you've proven to me that you're really good on a chart. Then you have zero chance, right? It is exactly, Steve, yeah, thank you. I mean, in my definition, I put confidence in there, yes. Discipline comes from confidence, which comes from successful trading at very low money levels so that you're thinking clearly. That's exactly right. And that's how you That's how you prove you know to read a chart. You have to learn technical analysis at an excellent level, and then you prove you know it by building confidence through successful trading at small, very small risk levels, and you build up the risk levels, period. Backtesting in what way, KO? For me, I know what I'm doing, but it's taking trades, not my plan. Okay. Okay, well then that's a discipline thing, Mike, for sure, yeah. Okay, KO, I don't know your name. You may not like me, or you may not like me after tonight. There's no such thing as backtesting strategies. And I know you're going to say, yeah, there is, Paul. I have this program that does it. It's zero help. It's zero help. You will never make a penny trying to backtest a strategy, period. You'll find that out sooner if you can. Because here's why. If you're saying that you can create some strategy and backtest it, and you think it's going to work in the future, well, now you're creating what would be called a black box. You're creating some magical formula that's going to work in the future. The problem is what you need to backtest, KO, is you need to take the actual trades you're doing and go back and review them with a what if analysis to say, what if I change this? What if I change that? What if I went for this target instead of, what if I managed like this instead of that? What if I entered here instead of there? What if I stopped it here instead of there? You need to backtest what you actually do, because the trades you take are what matter. There is never any strategy that'll work. I don't care how you backtest it or where you go. And you know what? I'll give you the ultimate thing, Kale. You backtest for the next 6 months, and you send me the magic strategy that works, okay? I'll offer that to anybody, and I'll never hear from them, because there's no such thing. So I know there's programs to do. As a matter of fact, I was very instrumental with the company. I used to work with them that actually, and maybe it's the company with it, does backtesting stuff, you know? But it will never, ever make you a successful trader. It will never, ever find you a strategy, period. Is that a joke, or is that true? You're fundamentally wrong if you despise it. I don't despise it, Vito. I'm saying that you are, it is absolutely proven in and of itself that it does not work. There's a million backtesting software programs out there, right? There's a million people doing it. Show me the magic thing. Go ahead and work on it for the next week and send me your magic formula that works. There's nothing you will find that ever works. Sure, what you will find is you will find stuff that worked in the past. Here's the reason, Vito, KO, and again, you may not like me or agree with me, whatever, that's fine. I don't care. I'm just telling you what it is. And what it is that trading can never be 100% objective. And to backtest a strategy, you have to be 100% objective. You have to say, I'm going to go long over the high of the last 23 bars and put a stop under the low of the last 26 bars. If the prior high in the day, blah, 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 and put in whatever formula you want, whatever it is, but it ends up being 100% objective. And that has been proven will never work. And I'm not really sure if you were trolling me or making a joke or actually telling me that I'm fundamentally wrong, but I'm not. Just trying to point you in the right direction. Now, you may learn stuff. Don't get me wrong, guys. You may learn stuff backtesting. I'm not saying it's a waste of time to do it. You may learn things. You may learn how to form your strategies you want to use going forward. You may develop a better sense of what to look at and what things kind of work and don't work. You may learn things. Don't get me wrong. You may learn things from trying to find. But what I'm saying is you will never find the magic formula. You'll never be successful by coming up with some magic thing. What you can do is you can use that, especially if you're newer, to say, okay, here's stuff that seems to kind of work. Here's stuff that I've noticed, and it may not be anything from your formulas directly. It may just simply be as you observe things, you say, boy, anything that moves above the prior day's high, the opening 5 minutes, never works. Okay, you just learn something, right? Don't go long that first 5 minutes if it's over prior day's high. And by the way, that is a true thing. So you may learn a lot of stuff. I'm just saying you're not going to develop a winning concept doing that. That's all. Trading will always involve some subjectivity. By the very definition, it has to. Well, one of the reasons, Don, is very simply is that for every winner, there's a loser, right? We can't all be winners. And to apply there's an objective formula would imply somehow that everybody can win, and you can't, right? Sure. Well, first of all, you're talking about Warren Buffett. You're talking about fun. Okay, you want to talk about it? We can. I don't know Jim Simmons. I don't know Charlie Munger. I'll talk about Warren Buffett if you want. So we didn't talk about fundamentals. Warren Buffett, are you saying Warren Buffett uses backtesting, FG? Or you just mean Warren Buffett is a fundamental trader? Fundamentals is a complete waste of time. I'll be doing the intro class a week from Friday. Come to the intro class and I'll explain to you, not just my opinion, I'll explain to you factually why it is impossible to make money from fundamentals. Now, here's the thing. You can be tricked and think that it does. And let me explain to you what fundamental trading is today and what Warren Buffett could do. I'll refer you to a movie called, a TV show called Billions. I watched the first season of Billions. I thought it was a fun show to watch. I didn't watch because I'm a trader. I just thought it was a fun show to watch. But they did fundamental trading there. Now, fundamental trading, the concept today is different than it was 60 years ago. You listening to me after you got there? 50, 60 years ago, information was valuable, right? If you've got information, you're paying for information, but what's become now is that information has become worthless. Years ago, you might have paid a lot of money to find the whisper number from your broker for Intel. Today, there's 77 sites that have the whisper number. Information is everywhere out there. Everybody has all the, everybody knows the company's fundamentals, book to value ratio, their balance sheet, their income. Everybody knows everything about every company, right? So where's your edge by going to look all this stuff up? Now your edge comes from finding new information. There's two ways you can get new information that is fundamentally beneficial to you. One is insider trading, which is usually illegal. If you live next door to the CEO of a company, he tells you, hey, we're screwed next earnings, go short the stock, congratulations. That's one way you can do it. The other way is the movie Billions I want to explain to you. What they did in the movie Billions is they did fundamental analysis. Now, they didn't go on the internet and look at what 200 million other people looked at and said, now that we all see these numbers, I'm going to make myself a superior brain and say I know better than everybody else knows what's going to happen. That's not what they did. They had it's a TV show, but this is what happens in real life if you're a fundamental trader today. They had a company that made computers that used three different computer chip companies. So three different computer chip companies delivered to this big computer company. And it was rumored the computer company was going to go down to two. In other words, get rid of one. And whatever one they fired was going to have serious problems because it was their major business. So what they did was they hired people to go sit in the parking lot 24/7 for 2 months, track every truck that came in, and when they found that truck from chip company C stopped showing up, they shorted the stock. So if you have millions of dollars at your disposal to go do stuff like that, to do stuff that nobody else in the world knows about, you have an edge. But you explain to me how you have an edge reading the fundamentals that are on a website that everyone in the world has already known and understood. Where people get tricked is because in a bullish market, you can buy a stock and go long because you read the fundamentals and you think they're good, because some idiot recommended it on TV, or because their logo is bright blue and you like bright blue. All those will work, believe it or not, in a bullish market if you go long. It doesn't matter. What makes traders is when things don't get so fun. So I've always said one thing you can do is to forget all this crap. If you're young, just go put all your money in the market and let it sit there for 30 years, 40 years, whatever it is. I wouldn't do it today, by the way, but next market crash, just start from zero and don't worry about all this stuff. But for those of you who do have to worry about it because you don't have that time and you're wondering what to do now, you're going to come into a period where you're going to get your head handed to you if you just think you can keep buying stocks based on fundamentals. You know when the fundamentals fall apart is after the stock price has been cut in half. For Vito, to me, backtesting is a misnomer of sorts. I've practiced on Ninja, playing a day, backward mode, month back, practice. Yeah, thanks, Mike, for the input. So let me emphasize again. I mean, the whole backtesting thing, it's perfectly fine to learn some things, and also some people call it backtesting, but another thing you can do is go and back in time and replay the charts. And that's a learning experience to me. That's not backtesting. That's going backwards in time and then go back 3 months and then play through a day by day and pretend trade and just say, okay, what would I be doing now? Here's my 5-minute chart. Here's my daily chart. Here's my weekly chart, whatever it is. And go through and say, okay, what would I be doing? Blah, 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 blah. And oh, okay, boy, I screwed that up. And you learn from that. That's a great thing to do, Mike. But that's not what they're talking about, right? I believe they're talking about finding the magic formula by keep trying to do different objective things until something works, and it won't work 2 weeks from now, guaranteed. I haven't told this other story. Let me give you the other story too, and Mike, you'll probably love this one. Long time ago, beginning of DTS, 6 years ago, I was doing the same talk, just talking about it's a waste of time. And a guy said to me on the screen, like right now, it's just like reproduced right now, and he said, Paul, can I call you when we're done? I said, sure. You know the number, blah, blah. He calls me. You know what he tells me? He tells me that he worked for Goldman Sachs. I think it was Goldman Sachs, big name company. And you know what his job was? He was the number 2 person in charge of black boxes. In other words, finding trading formulas that work. And he said that he was on the job 2 years and they dropped it. They gave up. Now, they didn't formally drop it. I mean, you go to any major company, they'll still tell you there's a black box, but they said they've given up trying to make it work because it doesn't. So they still promote stuff. And, you know, if you have a guy that's changing the formula every day, is that really a black box, or are you just following somebody who's trading every day? So they still have stuff they promote. But he said the concept of trying to find the magic formula, he said, their best people spending millions of dollars couldn't do it. So if you think you can do it using some software program for $39, and again, the software program is not an issue. Anything can do it. You can find a software program, backtest anything you want. You're never going to find success. You may get a good education though, all right? So there's my 2 cents over 12 minutes. Good comment, good question. I love the discussion, and feel free to tell me I'm an idiot. I don't care. But to me, that's not an opinion. That's an absolute fact, because I've been doing this a long time, and I've been all around the block in every direction. Questions, comments, anything else you want to talk about? And if you'd like to voice your concerns and email me, feel free, if you don't want to talk in here. Camille, I know I'm right. My goal is to convince all of you. If you come to the intro class, like I say, I present it in a way that I believe you cannot even argue with me. Looks like we're done. Hope you enjoyed tonight. Nothing going on the rest of the week. I believe a week from Friday is probably the intro class. We start up with the live seminars again. And I'll probably have a couple of emails coming out to you guys, a couple of educational things. I sent a bunch out over the last 3-4 weeks. Hopefully you got them. It went quick and we're 15 minutes over. All right. Have a great night, everybody.